Hey everyone, we're going to talk about the economy's hidden engine today, the global credit market. Now I know the stock market gets all the glory, all the headlines, right? But it's actually the credit market that's pulling the strings, really setting the pace for the entire global economy. If you can understand this, you get this incredible superpower for seeing what's really going on. So let's jump in.
So just how big are we talking? Well, get this. The credit market is about 3 times bigger than the entire global stock market combined. It is an absolute giant. And it's quietly working in the background, shaping everything from a huge company's decision to build a new factory to, the interest rate you're going to get on your next car loan.
And that's exactly why it's so important. You'll often hear economists call it the lifeblood of economic activity. And honestly, that's the perfect way to think about it. It's like the financial system's circulatory system. It's pumping capital, that's the money needed for growth, out to businesses, to governments, and to people. When that blood is flowing smoothly, the economy is healthy and strong. It's that simple.
All right, so let's pop the hood on this engine and see how it works. And I promise, you do not need to be some Wall Street whiz to get this. We're going to break down exactly what it is, and more importantly, why its health matters directly to you and your wallet.
So at its most basic level, the credit market is just a giant marketplace. But instead of fruits and vegetables, people are buying and selling debt, things like bonds and loans. You've got corporations who need cash to grow and innovate. You've got governments that need to fund things like roads and schools. And then there's us, individuals. The health of this market is what determines the interest rates we pay on our mortgages, our car loans, even our credit cards.
So here's the key takeaway. Because it's so fundamental to everything, the credit market works like an amazing barometer for the health of the economy. It's often where you see the first signs of a storm brewing, long before it shows up anywhere else. Why? Because the big players in this market, they have to react to even the tiniest shifts, making it a really powerful leading indicator.
And that brings us to the single most important number that you're probably not watching. If the credit market is our barometer, then something called the credit spread is the needle on that dial. This one number tells you almost everything you need to know about fear and confidence in the economy. It's a game changer.
Okay, so what in the world is a credit spread? It's actually super simple. It is just the difference in the yield or the payout you get between two different bonds. Now, these bonds have the same time limit, say 10 years, but they have different levels of risk. Typically, you're comparing a corporate bond to a super safe US government bond.
Let's make this real with an example. Imagine a company's bond pays you 5% a year. At the same time, a US Treasury bond, backed by the full faith and credit of the US government, only pays you 3%. Now, that Treasury bond is considered basically risk-free. The company, on the other hand, well, it could go out of business. So to convince you to take on that extra risk, they have to pay you more. That extra 2%, that is the credit spread. It is literally the price of risk in the market.
Now here's where it gets really interesting. These spreads, they aren't set in stone. They're moving all the time, up and down. And if you learn how to watch that movement, you can start to read the signals the market is sending us about what's coming next for the economy.
It all comes down to mood. When investors get scared about the economy, they get risk-averse. They dump their risky corporate bonds and rush into the safety of government bonds. This causes the spread between the two to get wider. So a widening spread signals fear. On the flip side, when everyone's feeling good and confident, they're happy to take on more risk for a smaller reward. The spread gets smaller, or narrows. A narrowing spread signals confidence.
Okay, so that's the theory. But what does a real 5-alarm fire look like? When fear really takes over the market, what kind of signal does it send? What does it actually look like on a chart?
Well, the cool thing is you can actually see it for yourself. Right now, I'm going to show you how to build your very own Economist Toolkit. And the best part, the main tool you need is completely 100% free for anyone to use.
Seriously, you don't need one of those $100,000 Bloomberg terminals you see in the movies. You don't need any expensive subscription at all. All you need is a website run by the US Federal Reserve called FRED, which is short for Federal Reserve Economic Data. It's an absolutely incredible public resource.
And using it is so easy. First, you just go to the FRED website. Second, you search for the data on a risky corporate bond. We'll call that Series A. Third, you search for the data on the safe 10-year Treasury bond. That's Series B. And finally, the last step, you just tell FRED to make you a custom chart using a simple formula, A minus B. And that's it. Boom, you've just created your very own credit spread chart.
And this is what you're going to see. It is just wow. The power of this thing is so obvious the second you look at it. Check out those massive spikes. The credit spread absolutely blew out right before or during every single major modern recession. The dot-com bust in 2001, the global financial crisis in '08, and of course, the COVID-19 recession in 2020. It's like a financial fire alarm.
So, why does any of this matter? Well, it's about going from just looking at data to actually making better decisions. This isn't just some abstract number on a screen, it's a real-time story about our collective economic health, and you can read it.
So let's just quickly recap the big points. First, the credit market is the huge hidden engine of the economy. Second, the credit spread is your personal barometer for risk. Remember, widening spreads mean fear is on the rise. Narrowing spreads mean confidence is growing. And the most important part? You now know how to track this vital sign yourself for free anytime you want using Fred.
So there you have it. You now have the knowledge, you have the tools, you know how to lean in and listen to what the credit market is whispering, or sometimes what it's screaming. The only question left is, what is it telling you, right now, today?